Hey everyone, welcome to Above Board with Candor Path. Now, these last couple of weeks, or Matt, I guess I should say months, like the world's kind of crazy right now, right? Like
You
markets
don't
all over
say,
the
John. What are you
place.
talking about? It looks normal to me. I mean, I don't know what you're talking about. Can you elaborate?
Yeah, it just, bad news everywhere you see. You almost don't even want to turn the news on because of just so much bad stuff that we see. From the start of the year, it was the potential of a war in Ukraine, things going on there, and then the markets going all over the place and
John,
interest
we're
rates.
here in Central Florida. We're preparing for a hurricane as if it
As
couldn't get any worse with the news. We are like hunkering down or whatever the latest topic is. Now, I did sit through Hurricane Andrew. So hurricanes are not a joke. They are meant to be taken very seriously. Those who make fun of them are clearly have not been through a big one. We've also had multiple weeks without power at our house. So it is a big one, but yes, you're right. It doesn't seem like we can escape the bad news these days.
Well, we're gonna do, instead of hurricane preparedness, which, yes, I did see you this weekend getting your house prepped and ready for it. But instead of hurricane preparedness, we're gonna talk about what's going on in the world, how you can be better prepared, and just things to be thinking about. And so what we did was, we have a number of clients that listen to our show, that follow us and support us, and thank you. You know who you are. Thank you for listening to us. And we decided we threw out a few questions to them. We said, hey, if we were to make an episode, more financial driven with what's going on with everything, what would you want to hear? What would you want maybe your adult son or daughter who's in their 30s and 40s in the accumulation phase of life? What would you want them to hear? What questions would you want to be answered? Or conversely, for folks that are in retirement, what are some of the things you want to hear? So we kind of took a collection of all of those questions. We distilled it down to a handful, and we're going to answer them today. So I guess I'll MC it, and then Matt, I'm gonna ask you the question. So you're on the spot. You're gonna have
Oh
to answer all
goodness.
these things today,
I'm
and we're
up
gonna
for
have
the
to come
challenge,
up with
John.
something catchy. We have Q&A with your CFA with Michael Scott, who will be on the show in a few weeks. But we're gonna have to come up with something catchy for like CFP. I can't quite figure out what rhymes with it, but we're working on it. We're working on it. Anyway, okay. So the first one, let's start with the folks that are in this accumulation build phase of their life. They're saving, they're growing, they maybe have kids. The world's gone crazy. The markets are all over the place. Bad news everywhere you turn. So I think a very common question is, do I continue to participate and add money into, let's say, my company 401k plan? What's your answer to that,
Yeah,
Matt?
it's a question that comes up very often, and it actually comes up every time the market goes down. And the market's gone down in 2020, 2018, 2015. It seems to happen every 3 to 5 years. It's not predictable. It's not like something we can throw in our calendar. It comes because of some underlying condition like COVID or like interest rates moving in a direction one way or the other. But it's one that comes up every single time, and it's very easy to answer. It's stop necessarily looking at the value and look how many shares you are purchasing each time that $100 or $1,000 comes out of your paycheck to contribute to your 401k. Look at those share balances. I recently had a client meeting not too long ago with good friends of mine that are also clients and that listened to our show. And she said in our client meeting, Matt, I haven't looked at my finances. How are you going to spend this one? What are we going to talk about today so it's not depressing? And I said, we're actually going to look and take it face on. We're going to look at every single number here. And part of the conversation then revolved around, all right, should we be stopping our 401k? Because every time we put that $100 in, it goes down. Are we even doing the right thing? And it always goes back to establishing that you have a plan, and we do have a plan in place. And then from that plan is not to deviate based upon what the market is doing. And it's to look at that 401k or look at that IRA, as we talked about in the pre-show, John. Not everyone has a 401k, right? There might be a simple IRA, and you might just be adding to your brokerage account at this point. But it's to look at it. It's first of all, make sure you're buying high quality positions, so the right investments. And then it's to continue with that purchasing, because as the share balances go down, as the market pulls back for that same dollar amount that you're putting in, you are buying more shares. And the hope is that when the market does recover, that recovers exponentially because you've been buying on the way down. Again, not an easy thing to do. And sometimes it defies our logic, or what we call behavioral finance. a lot of what John and I do for a living is to tell you to do the opposite of what your gut inclination is. In times of uncertainty, it's to go to cash and it's to bury everything under your mattress. And oftentimes, and at least historically speaking, that has not been the right move. Timing the market has always been very difficult to do. Getting out, extremely easy. Getting back in, extremely difficult. And so for our clients, it's again making sure we're looking at the overall plan. It's making sure they understand why we are making these contributions. And it's to look at it. It's painful at times, but that's what you oftentimes have a CFP for, is to make that complicated decision quite easy. What do you say, John?
Yeah, well, there's a lot of things I want to say to what you said. I would argue that so you often kind of think of, well, a financial plan for somebody that is in retirement. Like that's what you think of when you think of that. Like somebody who's 60 needs a financial plan, not somebody who's 35 or 45. But I argue that if we're trying to achieve retirement at whatever that age is, or whatever we're trying to build to, having that plan in place, as Matt said, it almost creates this rules based system that you can operate under. So you're planning if you're meeting with a financial person, or it's just you and your spouse and you're trying to figure this out and talk through stuff. You're pre-planning for all these things or these life events that are maybe out of our control. The market's going down or what have you, and you're creating these rules that regardless of what happens, we're going to continue systematically, let's say, adding to our company 401k because we get a match, because we know that we can buy shares that are on a discount as we're adding to it. And if we're not touching that money for like X amount of years, ideally a long time from now, we can give that room to grow and know that it's going to bounce all over the place. It's funny, we were looking at the chart of the S&P 500 when we started this, and from like 1980 to 2000, it's up like 1,000% in that time frame. But if you zoom in to that, there are periods of volatility even then that I'm sure folks back at that time, coming off of stagflation in the late 70s, early 80s, there was a lot of concern and market volatility, and everybody kind of talks about like how this time is different. That's sort of like the consensus. Like anytime we go through anything, it's, well, this is different because. And I'm not here to suggest that it is or isn't, but I am here to suggest that if you put that plan in place and you basically discuss those decisions on the front end, you don't it kind of you don't allow doubt to seep into your decision making, because you're just going to stick to your plan regardless of what's happening in the world. And I think that that's what's really important, because that behavioral finance side, everybody wants to invest and add money to, let's say, stocks when things are doing really well, and they want to take it out when things are not doing well. And by the very nature of that decision, they end up buying at the wrong time or selling at the wrong time, because they buy at the highs and they sell at the lows, which is quite like the exact opposite of what we want to accomplish. Yeah, go ahead.
And that's not even to mention some of the additional benefits you have of making those contributions, especially if it is a 401k. It might be tax deferred, right? Either you're either putting dollars in pre-tax or post-tax, whether it's a Roth 401k or traditional 401k, and there's a tax benefit either on the back end or it's today when you're making those contributions. So there's a number of reasons to continue with the plan. And I think back to your point, John, we don't have a crystal ball. We don't predict the future. Even when we have Ask Your CFA, when we have our very special Michael Scott on the podcast, he's not going to prognosticate. We are oftentimes looking backwards at history to see what happened. We looked back at 2008, 2009. What was the right thing to do in 2008, 2009? The right thing to do, as painful as it was to add to the portfolio, assuming that you have a broadly diversified investment, not buying single issue stocks that potentially could go away, but having a broad basket of securities, was continuing to make purchases during that time. Same with 2020, right? Going through COVID, that was a scary time. John and I have not experienced a pandemic in our lifetime. We, of course, read about 1911 or 12 or whenever that occurred and what happened during that period of time. But again, looking back on it, having a broadly diversified investment strategy, continuing your plan, you were able to come out of that. Looking at 2018, looking at 2015, each one of those time periods were negative market performance, or the S&P, the stock market, down double digits. In each one of those occasions, it was to continue on your path and continue adding to the portfolio where it was appropriate to, and then not make sizable shifts of your equity positions, of your stock positions. So
Yeah.
again, oftentimes rely back on history, not to say past performance is indicative of future results. That is never the case, but we have to have something to go off of. And when we
Yeah.
look back in time, we can sort of see what made sense during those same economic conditions then that they do now.
Yeah. And some of the other obvious things that maybe we didn't state is having, having that emergency bucket in place. We don't want to leverage or mortgage our future by going all in on this type of thing. Like we want to have a plan, stick to it. And part of that plan is having an emergency bucket, doing all of those right things. And I think I'm going to flip the script as I move on to the next question, which is, so instead of adding to our portfolio, we're in a phase of life like retirement where we are now living off of an income that our portfolio is providing. Markets are down, things are crazy. What can I do in that scenario to maybe just empower my own planning, feel like I'm a little more in control with all of this stuff that's happening that's out of our control?
I got to tell you, this is the group of clients that we have the most concerns about.
Right.
Not necessarily concern, but if you ask what keeps an advisor up at night, it's not the client in accumulation years during a down market who are adding to their 401k. I think we need to explain to that person what's going on. I think there needs to be a plan for those accumulation clients. It's the ones that are in retirement years. The market is down 20%. They're pulling out 5% per year of their portfolio to live off of. That means we have to come back up 25% or more, really. Actually, it's more than 25% just in order to break even. And I think with those clients in particular, first of all, it's having what we call a three bucket system so that we're not taking all of our income from the portfolio, but we've actually broken up that retirement account into three very distinct buckets: a long term bucket, which has a healthy amount of aggressive securities, a middle bucket, which is roughly half aggressive securities, half non aggressive securities, more conservative, and then a very conservative bucket on the front end of that. And that conservative bucket should be anywhere between a year to 2 years worth of income that is sitting there in a very safe and secure spot. And I think when times are really good, you pull from the long term bucket. And when times like right now in 2022, with the market being down, you're pulling from the more conservative bucket of money and continuously rebalancing this portfolio. So it's
Mm-hmm.
not an easy answer. These are the clients that really do keep us up at night because this is not the time for us to actually take everything and go conservative with it in terms of rebalancing. In fact, we have to move in the other direction because we have to get this portfolio back up to at least a break even standpoint so that for the next year we can take out another 4 to 5%. The last point I'll make, and then John, I'll let you jump into it, is the security selection at this point. It's looking at securities that have less growth and more dividends. So looking at a high dividend growth or a high dividend portfolio so that at least part of the income that is being used is coming from the dividend of the stocks, not coming from necessarily the growth, because there's not a ton of growth right now. So we need those dividends, and right now the S&P's averaging somewhere between 2.5% in the form of a dividend, is having a healthy dose of those dividend paying securities right now that's helping to provide some of that income so that we can be pulling from the more conservative bucket at this time.
Wow, I think we could probably do an entire episode on security selection, portfolio construction, all that stuff, and we won't for today. But you did say something that's really important that I think, again, this is money psychology. The idea that in retirement we have a bucket of dollars that, let's say, give us a runway of 12, 24, 36 months or what have you, where that, okay, I'm now insulated from where I'm taking my dollars from. I'm insulated from the market risk of what's happening, like, let's say, compared to my long-term bucket of dollars. And I think that that's really useful because even though, you'll probably log in, you check your accounts, you look at everything, you can kind of focus on this one account that's goal is to be conservative in nature, that this represents, let's say, my expenses for the next 1 to 3 years. And now we're creating an expectation for our own selves that, hey, regardless of what I noticed that happen, um, I noticed this be a very effective strategy for folks during COVID, and partially because it was very that market cycle was very truncated. I mean, if you look at like for 3 weeks, we saw the markets drop almost 35%. I mean, it was the most precipitous drop in the shortest amount of time I think we've ever seen. So for 3 weeks, we saw the markets do that, and then the following 7 to 9 months, the markets recovered it. So it was a relatively short period of time where there was a recovery. But I noticed that for folks who had those funds in this conservative bucket were able to maybe sleep at night a little bit better. They seemed to have a little more financial peace to their situation because they knew, all right, well, I've got runway of time. Yeah, things are crazy right now, but I'm not going to cut and run and, let's say, sell out of my portfolio and assure myself a loss after the markets just did what they did. I'm going to hang on, and I can, because I'm not pulling dollars from equities that are down right now. And I
I
think that
think you
that's more of a mental shift, but it's important to
Yeah,
realize.
I think you made a good point there. And it kind of goes back to what I said earlier. It's incredibly easy to get out of the markets. It's really easy to hit that sell button, but missing those days where the market goes up dramatically and there's no pre-warning for it. It's not like, hey,
Mhm.
next week it looks like it's going to go back up again. There is no predicting of it. Now, people will try to predict it and they'll try to maybe attach some technical theory to it, but you miss if you miss those days where it rallies strong and it's because you're sitting on the sidelines, you miss those days, there's never a good opportunity to get back in. There's never this opening where you're like, hey, now it makes sense to do so. Again, I think going back to 2020, like you just made the point, we didn't know in March how low this was going to go down, how far this drop was going to be. But what we did know was it seems like right now, compared to history, the investments were at such an extreme discount that you needed to rebalance into those. And
Yeah.
so, again, going back to not knowing the future, we can use a little bit of history to figure out what's the right decision to make. The last point that I'll make to kind of attach to what you were saying is having the money separated out. And I can't stress this enough. It's a physical barrier between our conservative accounts and our aggressive accounts. If you have everything in a same account, it's really hard to separate out, oh, this is my conservative money and this is my aggressive money. Oftentimes for clients, we'll open up 2 or 3 accounts and we'll actually have them separated out so that we can say when we're having these meetings, or that they can see, hey, this is my aggressive one. We're going to let this one continue to maintain the plan, and this is my conservative one, and this is where we're going to be taking our income from. Physically separating out those accounts is a really powerful tool you can do that costs nothing, but allows us to psychologically see where's the income coming from and where should the growth come from.
Well, you're talking to a guy who has 13 different savings accounts, so obviously, I love that. We've joked about that on the show, but I think having that actual physical separation does really create a good money psychology. And again, looking more under the short term with all my savings accounts, like my wife hit the nastiest nail I've ever seen in her tire. And I mean, this thing was flat as fuck. We're lucky, like the rim didn't get bent and broken, frankly. And it
Oh,
sucked.
Jackie.
It sucked, having to get a new tire, and of course, you got to get a matching tire on the other side. So now one tire turns into two tires. It's a whole scenario. But we have money in our auto bucket, and so having that buffer, kind of created some good peace of mind. We do have a friend of ours that's a listener as well, Krista. She has she's got us beaten though. I think she has like 20 savings accounts, so
Oh
even
my
even
goodness.
even greater. But to your point, that physical accounting and separation of those dollars can have a positive effect. And also, you're talking about staying in the market. I don't have the slide in front of me, but it was something like suggesting like S&P 500 over a stretch of 20 years, and if you missed the 10 best days in every year, what that drag effect would have on the return. I mean, it cut the return like in more than half. And it was just kind of this very powerful visual to realize, like, I can't time this thing. Nobody can. Why am I trying to? And so let's stay true to what our plan is. Okay, so as we wrap, I think there's a final question that I want to bring up, and it's more for So we've talked about those that are in the accumulation and growth phase. We've talked about the ones who are already in retirement. Now we're going to talk about a very unique class of folks who are maybe like, for the last several years, they've been planning to retire in 2022. Like maybe they turned 66 this year or whatever the case may be. Like this was going to be their exit year. And so they come to us, they say, hey guys, I'm ready to retire soon. But given what's happened this year and all of the uncertainty around that, is now a good time to retire? Do I punt this decision? What do I do? What would you say to somebody in that situation,
Yeah,
hypothetically?
the planning for retirement doesn't happen in a single year, right? It happens usually 3 to 5 years ahead of time. So the question I usually get is if it's a new client coming to us, have you been planning for this? And if it's an existing client, we probably did have a plan for this. We probably planned to retire at some point. And I think the key with retirement is first of all knowing, and we've talked about this in previous podcasts. There's a couple of solid rules that we have: is organization of your finances, having a budget, having an emergency savings. Right, those are the
Mm-hmm.
three tenets I think we personally believe in are the three most important. None of that has to do with stocks and bonds. Has to do with making sure that you have a plan. So I go back to that client and say, A, is there a budget? And is there a retirement budget? Because the retirement budget should be vastly different from the accumulation budget, right? Because you're not going to be saving as much in retirement. You're going to be spending at this point. So it's making sure that there is that system and there's a budget. The
Yeah.
next is there a plan, and is it a live plan? Plans are not great when they're given to you in a 3-ring binder and said, okay, now go execute. The minute that binder is printed, the minute that plan is printed, it's actually technically out of date. So again, we employ through software that we use a live plan, which moves and changes with the fluctuations of your account balances. So it's again asking if there's a plan. And then the last but not least is what is the emergency savings look like? Do we have enough to protect us and shelter us from this decline? I'd say that one of the biggest things is also being able to be flexible within your budget. During really good times is you can have some additional dollars being taken from the portfolio, but during the lean times are going through right now, can we tighten that budget up, that retirement budget, enough so that we're not stressing the portfolio as much when it goes down as much as it's gone down in such a long period of time? One point that I'll make, John, that kind of bringing back to 2020 happened in a relatively short period of time. It was very much like ripping off a Band-Aid, right? It went down dramatically, then it went up dramatically. 2022 is like death by 1,000 paper cuts, right? We're shooting this podcast in the month of September. We're almost 10 months into the year of just bad news after bad news, decline after decline. It seems like it's never going to end. And so that prolonging of a declining market oftentimes just wears on us. Seeing the news every single day of it going down or mostly going down, it just wears on you. And you're like, gosh, is this ever going to end? Will I be able to retire? You need to have a plan.
Yeah. Yeah. The good times, I guess if you look at historical, charts of the market and such, the good times do last significantly longer than the bad times do. But the bad times feel so bad that even though they're shorter in nature as compared to the good times, like they hurt more. And so they feel longer. They feel like they're never going to end. And I think that, one of the things in thinking about the answer to this final question for me is one of the first things I do with somebody when we start working with someone is project a financial plan. Okay. So if you want to retire at this date, or if you're already retired, like what's it going to look like? And, where your dollar is going to be and when you're 72 and 84 and 96 years old, like that type of thing. And we stress test that because you obviously don't want just perfect case scenarios to happen, because that's just not how life works. And so we stress test that and we make assumptions that there's going to be recessions in your retirement life. I mean, um, it is just not realistic to assume that if you're going to retire for a 30-year life cycle, let's just say hypothetically speaking, between the ages of like 60 to 90, and it could be longer with like longevity and science, and me, I want to live to 120. So it's like it could be way longer. But let's say at least several decades of time, it is not conceivable to think that we would always have economic prosperity. There are going to be periods of expansion and contraction, both in the economy and in the market, and that's normal. And so we stress test for those situations. So though it may not feel ideal to, let's say, retire into a recessionary environment, the likelihood is it's not going to be your last either. Like you're going to experience that in retirement again in the next decade. I mean, I forget what the statistics are, how frequently there are bear markets and recessions, but it's going to happen again. And so again, though it doesn't feel good, though it feels like elongated because, the bad times always feel longer than they maybe really are. I would argue that if you have the right plan in place, you do all the stress testing ahead of time, and like you said, Matt, like, you're 3 to 5 years ahead of this topic. You're thinking about it, you're planning for what that eventual date is. And so if everything else that you can control is right and lined up and good to go, we're going to experience more than one recessionary environment. And so not to, my message is not to let that negatively impact. Now, if your planning was based on perfect case scenarios all across the board and you're retiring into a year like 2022, it might not work. But I think this is a more of a conversation on focusing what you can control.
Yeah, we had a client retire last year, and she was in her 60s. And my she's like, okay, so now I'm retired. Do we make everything super conservative? And I said, Sue, you're retiring at, I don't know what, 60 and change. I said, you probably started like your peak earning years, like beginning your career, in your 20s. You're kind of coming out of your 20s off of college or off of starting to work. And she really started a career like at 30. I said, from 30 to 62, you were in your accumulation years. From 62 probably to 92, you're going to be in your income years. You're going to be retired for as long as you were working. Let's put that into perspective. We need continued growth on the retirement portfolio, because you're probably going to retire for as long as you actually like really worked for. And so
Wild.
giving them that perspective was like, wow. So yeah, we're going to go through a number of market cycles. B, we've got to continue to grow this, because I'm going to have to live off of this for the next 30 potential 30, we don't know how long we're going to live for. John's going to live to 120, but we usually run our retirement
What I
plans to
want.
at least age 100. But I looked at the scenario and I'm like, no, this is, now we need to pivot. We need to move things around, and we need to have this 1 year, retirement, cash portfolio, or conservative portfolio, so we can pull off of it during downtimes. But you're going to be retired for as long as you had your peak earning years for. And that really kind of puts it in perspective sometimes. Is there's not necessarily a dramatic change in strategy. There's going to be some tweaks to it. But for most of our clients, and again, those that are in really good health, they're going to have a really long-term perspective. You need to have a really
Yeah.
long-term perspective on what your retirement dollars are doing.
Did you know that the ages of 60 to 80 statistically are the happiest ages of one's lifetime? Did you know
I,
that?
I did not know that, John.
So
Thank you for enlightening.
I was reading it. I heard about it on a podcast that I was listening to, and it was Ray Dalio. So I mean, it was like, he was talking about this study, and I thought it was really cool. And I think the goal is to keep those your happiest years. So like focus on the good planning, so you don't have to worry about all the crazy things happening. Well, I have to imagine one of the reasons that they're their happiest years, and I want to do an entire podcast on this topic, but I would have to imagine that it's because you've gone through all those decades of angst and worry and fear and anxiety and raising children and watching them grow and doing all these things, that when you hit that age, if you've done all the right planning, you can like maintain that level of happiness. I don't know, it just
Yeah.
seems kind of cool. So like my thought is
The,
like, if 60 to 80 are the happiest years, let's work to keep it your happiest years, man. Like,
I think of it the other way. There's a musician that I love. His name is Jason Isbell, and he says, life is slow up until age 18. I'm going to butcher the quote, but life is slow up until age 18. Then at 21, it picks up speed. And it really is the truth, because like it seems like when you're in that one, well, you really don't remember one, but let's just say you're in that age 5 to age 18, like everything is so slow. I go to school every day, like another summer comes, like it's so slow. And then at 21, like something, like clicks, and you're like, oh crap, I'm an adult. I say this every night before going to bed, when I lay down and my wife's there, and I say, God, I was just here a second ago, right? I just got up a second ago, and now I'm laying back down again. The day went
no.
by so quick. The kids had activities. I worked all day. She did all of the things that she's doing, and like we were just here a second ago. It's happening so quick. And I
Yeah.
think that's a reminder, kind of back to your point, is you got to enjoy it. And if 60 to 80 is the most enjoyable years, you still got to enjoy the ride up to that point, because we don't always know if we're going to make it that long.
I like that, man. Time really does bend, doesn't it? Depending on the
Yeah.
situation. I feel like it's still going by at the same. 60 seconds is still 60 seconds, but some days it feels like it's a blink, and other times it can go by slow. So it's as volatile as the stock market, apparently. Well, hey, listen. As we wrap up today, thank you guys so much for listening to us on Above Board. We've got tons of more topics as we've asked more clients to kind of submit Q&As to us of things that they'd like to hear us talk about on the show. Not the least of which, I think getting a little more granular from today's topic. In the future discussions, we're going to talk about things like I bonds and interest rates and tax loss harvesting. So lots of good stuff forthcoming. And the Rich B, we miss you. He woke up, I believe, yesterday with absolutely no voice. So he has not had a voice for the last couple of days, which is probably really difficult when your career is speaking. I can imagine that's like your asset. We should talk to him about like Lloyd's of London insurance to like get his voice insured.
Ooh, we can insure his
I
voice.
don't know. That's a
I
thing,
think that's
right?
a thing.
That's
I
a
think we
thing.
can do that. I think we can do
But
that.
anyway, to all the listeners out there, thank you so much as always for being a part of this conversation with us. And we look forward to seeing you next week. Bye, guys.